right, what's up everybody? We will be live in just a moment here. If you could hear me, just leave a like in the chat. And if we're streaming in 1080p, just leave a thumbs up as well. Apologize for being late. It was kind of a crazy day today. Okay, it looks like we are good to go. So good evening everybody and welcome back to Walks and Wall Street. Today is January 11th, 2024. It's about 10:12 p.m. Eastern time here in New York City. Again, apologies for being late, but it was a crazy day. I'm pretty much just finishing up the day right now. I wanted to pop on real quick. A lot to cover, a lot to talk about. Obviously today, the big breaking news of the day was the inflation numbers. So the last inflation print for 2023 was released this morning at 10 a.m. So the consumer price index. So if you look at the all items reading for CPI for December of 2023, we came in at 3.4%. Now, in November 2023, we came in at 3.1%. So a little bit of an uptick since November. However, I am a little bit optimistic about this report for the following reason. Now, I think it'd be best if you want to follow along, just type !CPI in the chat. Once again, !CPI in the chat, and it'll drop the link to the Bureau of Labor Statistics website. And what I want you to do, you're going to see something that's called the 12-month percentage change for Consumer Price Index of all categories. And I want you to deselect everything and only select shelter. Okay, now as we know, shelter makes up about 40% of CPI. And as you'll notice, we've covered this multiple times, but shelter peaked in the United States in March of 2023, right at 8.2%. And we've been in decline every single month since March of 2023. Now, for the December reading, we came in at 6.2%, which is encouraging, right? Because if you look back at November, shelter was 6.5%, October was 6.7%, and September was 7.2%. So I wrote an article about this probably about 3 or 4 months ago now, and it was called In Order of Liquidity. Okay, so during a tightening cycle, we'll just quickly review this, as the Federal Reserve transitions their monetary policy from quantitative easing to quantitative tightening, the asset classes which reprice the fastest to accommodate a higher interest rate environment tend to be the asset classes with the highest order of liquidity, right? So if you think back to your Finance 101 class in college, when they're talking about how to read a balance sheet, it's in order of liquidity. So as the Federal Reserve starts to raise interest rates, equities, right, or stocks tend to reprice the fastest because they're very liquid. And real estate assets, both commercial as well as residential, they tend to reprice the slowest for a higher interest rate environment because it's not as liquid, right? So for a little bit of comparative analysis here, again, if you type !CPI in the chat, I want you to now select all items as well as shelter. And you'll notice a very, very interesting correlation here. So CPI, or the headline number, in the United States peaked in June of 2022. Oh, hold on one second. Getting a phone call here at almost 11 at night. Anyway, so CPI in the United States for the headline number, we peaked in June of 2022. But if you look at where shelter was in June of 22, let's just go there real quick. Shelter costs were really just ramping to the upside in June of 2022. So you had shelter at 5.6% in June of 2022, and it ran all the way until March of 2023 at 8.2%. So you had pretty much every single item in the inflation report rolling over and correcting, while you had a divergence with shelter continuously going to the upside. So the point being is that if you think about the Federal Reserve, right, and their dual mandate. Now, the dual mandate set by Federal Reserve Chairman Jerome Powell is as follows. They want price stability, right, or to bring back inflation down to their 2% target and maximum employment. So the target is 2%, okay, for CPI. That is the Federal Reserve's mandated target. We're a little bit of ways away from that. We just got a 3.4% print, but assuming, and again, we should never assume, but we can make this assumption because we're basing it off of data, which we're going to talk about later. If we assume that CPI, or if we assume that shelter costs will continue to roll over here, which I think they will, because shelter is a laggard, right? I think that the Federal Reserve will hit their 2% target in 2024. So once again, I'll just quickly take you guys behind the desk here as we're sitting outside 432 Park Avenue. So this is the shelter component, and shelter makes up about 40% of the entire CPI number. So in March of 2023, we peaked at 8.2%, and we've started to roll over ever since. But if we deselect shelter and go to all items, CPI, the headline number, was already starting to roll over in mid-2022, right? So what does that tell us? That tells us that shelter is lagging, and if we continue to roll over here in shelter, well, you could have a pretty severe collapse in CPI. So I think the report was okay. All right, we're gonna go ahead and get started here, everybody, in just a moment. Just a quick announcement. Last Thursday, okay, right at the market closed, I did send everybody the first 2024 issue of our free financial newsletter. So if you did not receive that yet, just go ahead and check your spam folder, or if you want to sign up to receive it, go ahead and scan the QR code on your screen, or type !news, NEWS, in the chat, and the Nightbot will drop the link to our Substack. There was a lot of important information that we covered in the newsletter. I'll take you guys behind the desk once again. We wrote about how the market overcame adversity in 2023 with the collapse of Silicon Valley Bank, Signature Bank, First Republic, and the tightest monetary conditions we've had in a decade. We then went on to talk about historical market performance of the S&P 500 in presidential election years. Okay, how does the market perform when a Republican is elected or a Democrat is reelected? And we did a deep analysis of every single president going back to 1928, okay, how the market performed under each president. Then we did a deep dive into the Institute for Supply Management PMI numbers. We did an analysis of the potential return of private equity in the IPO markets. We did an analysis of KKR, Blackstone, and Goldman Sachs. And last but not least, we finished off the newsletter with a bull thesis on India, Japan, and a bear thesis on China. So again, if you'd like to receive that, we send out all of our free research every other Thursday, right as the market closes. So just scan the QR code on your screen, punch in your email, or type !news, NEWS, in the chat. I'm gonna go ahead and close up my laptop here, and we will get started. Thank you all for joining us tonight on this very late stream. Oh, I lied. I actually have one more announcement, not to drag this on. But I have some good news. So you are now able, okay, to take the valuation and corporate finance classes at NYU's Stern School of Business, taught by Professor DeModern this spring. Okay, now as always, you are more than welcome to join virtually. You can access all of the material, all of the decks, and you could even take the exam. Okay, I will be joining this class, so if you want to take it with me, I will drop the link in the description. Again, this is one of the best professors for corporate finance, in my view, in the entire world. At NYU Stern School of Business is offering this course for free. So you could go to NYU Stern and pay, $30,000 for the course, or you could take it for free with us online. Hopefully I will be seeing you in the course, because I will be joining. So if you want to join that, go ahead and click the link in the description, and it's going to take you to the page. Okay, now if you're not heavy on the quantitative side and you're a little bit intimidated by this course, not to worry. We do have the sort of a prep document here for all of you that I recommend going through before you actually take the class. Okay, it's going to be an action-packed course, and hopefully I see you guys in there with Professor DeModern. All right. Cool. All right, guys, let me get this QR code off the screen here and let's get started. What a long day, but a very successful day. We are currently standing outside the very famous and gorgeous 432 Park Avenue building right here. Look at that. Now, you know what's interesting? At the very beginning of this live stream, okay, if you scroll all the way to the beginning, I believe Harry Macklow himself was standing right next to us, walking his dogs, which was pretty cool. I'm almost 100% certain that was him. So he is probably one of the most well-known real estate developers in New York City. We always talk about One Wall Street, which was the largest office to condo conversion in New York City's history. That was put on by Macklow Properties. But the most famous building put on by Harry Macklow was this guy right here, 432. Pretty cool. All right, guys, let's see who we got. I see my good friend Gary Carpenter. Good to see you. Optimus17, thanks for joining us. Latha, Swearworks, appreciate you. Chris B says good evening, everybody. Joan K, MBA Elias, thank you for joining us on this very late night live stream. Stephen Bate, Boomer Tuber, thank you so much for your very generous $1 donation. I appreciate you very much. Tina says thank you for the link, Tom. See you in the class. Yeah, I mean, I would highly recommend it. It's I think it'll be fun. You know, it's a challenge. It's free education, right? So for those of you who don't know, because we do have a lot of new viewers, one of the most, I would say, sought after classes at New York University's Stern School of Business is the corporate finance as well as security analysis course taught by Professor DeModeran, who is considered to be one of the most highly renowned finance professors in the entire world. He teaches at NYU Stern School of Business. Very, very nice guy. And he's nice enough to be able to open up his courses for free for anybody to take online. Now, obviously, you're not going to get credit hours, right, towards your MBA. But what I think is more important than, you know, the physical piece of paper is the knowledge that you accumulate throughout life. So if you have an opportunity to learn, right, and sit through these lectures virtually from one of the greatest finance professors of all time, he is coined the Dean of Valuation. I would do it. It's fun. So click the link in the chat somewhere. And yeah, maybe I'll see you guys in there. Look at this. This is the Aston Martin showroom here. Let's see who else we got in the chat. Hey, Brent Thompson says, hey, Tom and everybody, stay warm. Nasty weather for Florida. Oh, nasty weather, I think for everybody is forecasted this weekend, right? What is it called? The bomb cyclone or something? Interesting. Marcus has joined a little late. Where can I find the link to the class? Well, do you have the Substack application? So for anybody who doesn't have the Substack application, if you download it and you go to our Walks in Wall Street page, I've activated a cool feature on that Substack application. It's a group chat. So anybody who subscribes to the newsletter can have access to our group chat. And I put the link where you can sign up for all of the coursework at NYU Stern School of Business for free in that chat. So check it out. If you type !news, N-E-W-S, in the chat, it'll drop the link and you can check it out. Brian reads, the street seems so quiet. Very quiet, mainly because it's 10 o'clock at night, and this is Park Avenue, where there's mainly all office buildings, which, speaking of office buildings, right here is 425 Park Avenue, which is one of the newest Class A office towers anywhere in the city, which is pretty cool. Yeah, someone says it's a huge day for ETFs. Yeah, so today was the official first day of trading for all of the spot Bitcoin ETFs, in which we talked about last night. Now, an interesting thing, I think there was like $4.7 billion worth of volume. I think it smashed records across the board for any ETF debut, I believe. I posted the exact amount on our Twitter page, and Substack. But I think the total trading volume for the day was somewhere like 4.7 billion, I think. That's a lot. That's a lot. So yeah, regardless of if you like Bitcoin, you couldn't care less about it, you think it's a fraud, I still think it's important to pay attention to it. And I said last night we were going to talk about the reason why, and we'll quickly talk about that now as we're walking down 57th Street. But, you know, cryptocurrencies in general, right, like Bitcoin, I define them as risk assets, in my view, right? There could be some debate there. This is the old Four Seasons Hotel that's actually going to reopen. This thing has been vacant since the pandemic, but thankfully it's actually going to reopen rather soon, right here. It's been totally closed down since the pandemic. Let's just cross the street just to get away from some of the construction here. But being that cryptocurrencies and Bitcoin are risk assets, right? One of the things that we should be paying attention to is the demand in the marketplace for these assets. So even though you're not trading them personally or you don't own them personally, you can kind of gauge and check the market's temperature for market participants' appetite for risk, should these assets be performing well, right? Generally speaking, that's why I think you, even though you're not trading these and maybe even don't like them, you should still pay attention to how they're trading and the like. Looks like everybody's taken down their Christmas lights for the year. Hey, Gary Carpenter, what's going on? Swearworks says GBTC was about half of the 4.6 billion volume. Hey, Steph UF, what's up? Welcome. We're gonna head to the Upper East Side tonight. We'll get off of 57th Street. Now, apparently, Vanguard issued a statement to all of their clients and customers saying they will not allow Vanguard customers to purchase these ETFs because it is against their investment philosophy. Now, is that going to materially hurt Vanguard's business? I say probably not. To be honest, I mean, Vanguard manages trillions of dollars. So even if there's, you know, even $10 billion of capital flight to another broker dealer, I don't think it's going to make any material impact. I mean, what do you guys think? Agree, disagree? Maybe over the long term, as, you know, the Gen Z and millennials get a bit older and you have that transfer of wealth, maybe it'll have a more material impact. Hey, Leo Berger, thank you so much for your very generous $20 donation. I appreciate it very much, and thank you for the support. Leo says, hey Tom, this is a thank you. Oh, for that brave and impressive Tuesday night stream under the rain. I know, that was a fun stream, crazy stream, wild stream. Guys, the weather has not been good this year in 2024. It's been kind of dark, gray, rainy, windy almost every day. We're not off to that good of a start in New York in terms of weather. Duzzy says Vanguard's demographic is probably not a fan of crypto. I agree. Brian says, I agree, no impact whatsoever. I think not yet, right? I think not yet. Now, the last thing we'll sort of say about the Bitcoin, because we did talk about it a lot yesterday, and for whatever reason, every time we do talk about it on the stream, I get a barrage of emails, which I get. It's a turbocharged topic. But what I don't think a lot of people are ready for is we're about to embark on one of the largest wealth transfer effects ever, right? From the boomers to millennials. So millennials and Gen Z, over the next, I would say, decade, are about to inherit the most amount of money in human history being passed down. So I do think it's important. It may be a little bit of a stretch, okay? But I do think it's important, as if I was a large asset manager right? Like Vanguard or something like that. I would have a serious conversation and sit down and say, look, a lot of this wealth is going to be passed down to generations. Gen Z and millennials seem to be more open and susceptible to online digital currencies, digital payments, Bitcoin and cryptocurrencies alike. And if I'm an asset manager, a broker dealer, and I want to stay in business and gain market share, I should be being proactive, right, into having the products and services available for my customers that I know they're going to want 10 years, 20 years from now, right? It's kind of like that adapt or die. So even if you're, one of these old guys or girls at the firm and you don't, necessarily agree with the products, the reality is a lot of your customers do. And if you want to stay in business long term, you need to be a one-stop shop to offer those services to your customers to keep them happy. Is that a stretch? Maybe. But if I worked at Vanguard and I was sitting around the board meeting today, that would sort of be my insight I would give to the CEO. I say, I know it's against your investment philosophy today, but you have to think about our customers and clients that are young Gen Z and millennials that are about to inherit all this wealth, and they're not against it. They're actually for it, right? Younger people tend to be more, I would say, less abrasive towards the digital economy and the digital ecosystem as a whole. Any agreements, disagreements, thoughts on that? Anyway, all right, everybody, this is the GM building. We're standing right outside of the Apple store, and that is 53 West 53rd. Joe E says, good evening, Tom and team. Joe E says, I just don't trust cryptocurrency. A lot of people don't. You're not alone. John Kelly says, agreed, Tom. Most people on the planet have no clue this is going on either. I've been buying and I'm 20 years old. Oh, you're 20 years older than me. Got it. The shock is unfolding before their eyes. Yeah, I mean, look, maybe this thing really, really works. And this is what we were sort of talking about yesterday as it relates to setting up an asymmetric risk profile. Whoa, look at that. This is kind of cool to stand under this thing, right? So even if, let's say, you're not, over the moon about this whole Bitcoin thing, what if even there's like a 20% probability that it actually works and grows into a multi-trillion-dollar asset class in and of itself? I mean, your risk reward parameters are so skewed to the upside, it's crazy, right? You risk, maybe 1 or 2% of your net worth to maybe make a 50x. That's like a venture investment for like almost no capital outlay at all. That's how I think about it. Again, it doesn't mean I'm right, but as a trader and investor, if I see value in it, right, the unconfiscatable properties of it, that's why I would never buy it through one of these ETFs. That's why I kind of think the ETF is a little bit silly, but anyway, to each their own. Man, thank God it's not windy tonight. My ears were killing me last night. Druzzy says, considering Vanguard is normally for retirement, I wouldn't want my money in such a volatile asset. Maybe an opt-in feature, but not something default. Yeah, I get that for sure. I think even though it doesn't necessarily align with Vanguard's principles, you should still be able to offer it to your customers. That doesn't mean, you have to at least give them the option, right? You have to give them the option of doing it. It doesn't mean that the advisors at Vanguard have to recommend it, but I think it's just kind of a stupid business practice not to at least offer the product that all of your competitors are offering and could potentially be, the next emerging asset class. To me, that just seems a tad bit, it just seems a little stubborn. That would just kind of be my opinion on that. You got to have an open mind, right? And at a very old firm like Vanguard, I think they should have, some younger people at the decision-making table to say, look, this, you know, this could quite potentially be the deciding factor of having our, you know, firm flourish for the next 12 to 20 years, and us falling behind. Hey, Hawaii, what's up? Good to see you. Thanks for joining us. Ed Dunkel says eventually MicroStrategy will be in the S&P 500, so a lot of Bitcoin haters will end up owning Bitcoin anyway. Yeah, Ed, it's hilarious because MicroStrategy is now really just a kind of a Bitcoin ETF derivative in and of itself, right? I mean, it really is. For those of you who don't know, Michael Saylor, right, is the CEO and founder of MicroStrategy, and essentially what he's been doing is just taking all the money on his balance sheet and buying Bitcoin. I'm not saying that's the right thing to do, okay? But I've actually have MicroStrategy. I believe the ticker symbol is MSTR. I just have it on my watch list to gauge risk appetite for Bitcoin. You could essentially use MicroStrategy as a leading indicator of how the crypto markets are performing. It's very cartoonishly ridiculous. I mean, the way that that guy is running his firm. But look, maybe we'll look back and he'll be a genius. So who knows? But good to see you, Ed. No, I didn't get a mic. Austin City Limits is did you get a mic? I didn't have time today. I was running around like crazy today. Mia says, I think that Vanguard has a reputation that stands and they don't have to do what everyone else does. Maybe. Yeah, I mean, maybe you're right. You know, I guess time will tell, but I guess my only point is that businesses need to adapt or die. And it's not like they have to change their whole business model. It's just offering trading on these products that everybody already offers anyway. It's not like they have to create their own Vanguard Bitcoin ETF. You just have to allow your exchange to make the market on the ETF. That's all. So anyway, all right, let's shift gears here a little bit, folks, and we'll talk about the inflation report. So if you're just joining and you didn't hear the big news today on Wall Street, in my view, it was the Bureau of Labor Statistics releasing their December CPI report. So this is the last data set that we've gotten for 2023, right? Obviously, December is the last month of the year. So inflation ticked up a little bit month over month, but more importantly, and I would say encouragingly, right, not to just be the eternal optimist, but if you want to follow along in this conversation, I think it's important to see it as a visual. So if you type exclamation point CPI in the chat, the Nightbot is going to drop the link to the infographic of the 12-month rolling average of every single component in the CPI report. So you'll see the headline number, you'll see energy, you'll see shelter, you'll see food at home, and you know, on and on and on, right? Now, what I've been watching, the specific category that I've been watching the most is shelter costs, because shelter makes up about 40% of the entire number. And if the goal, right, if we think about the Federal Reserve's dual mandate, it is number one, price stability, and number two, maximum employment. This is the Trump Tower. That's the entrance to the residences. So if the Fed wants to bring inflation back down to their 2% target, the number one component that's going to get it there is going to be shelter costs. So if we don't have improvement in shelter coming down, well, there's no shot that you're going to get to 2%, right? Because it makes up such a large chunk of the number anyway. So the good news is shelter continues to decline, right? So again, click that link. It'll take you to the Bureau of Labor Statistics website, and deselect every category except shelter. And what do you notice? Well, you'll notice that in March of 2023, that's when shelter peaked. And I believe this is the 8th consecutive month of declines in shelter costs. My view is that we're going to continue to roll over and ease up a little bit here for shelter, which I think is good. Because if you think about some of the largest expenses for a US consumer, well, everybody pays rent, you have to eat, and you got to put gas in your car. So I don't want to make any assumptions, but based upon your budget, if everybody watching the live stream here had to go back in their monthly expenses and say, yep, that's my largest expense, would it be fair to say that shelter or your rent or your mortgage payment is probably your largest monthly expense? Okay, let's just ask the question. Who here in the chat, if you look at your budget a month, spends most of their money on shelter, rent, mortgage, etc.? I do, personally, right? Hey, Joan K, what's up? This is the University Club, one of my favorite buildings. Optimus is definitely housing costs the most, particularly in a city like New York, right? Where the cost of rent is ridiculous. Druzzy says definitely rent. Cindy Foley says yes. Michelle Henry says yes, my rent is my biggest expense. Cindy Foley says yes. Lee says federal taxes are the largest monthly expenditure for most. Yeah, outside of like income taxes that are taken out of your paycheck, probably, yeah. Melanie says my mortgage and maintenance fees are definitely the highest. Yeah, so overwhelmingly, generally speaking, yeah. So look, that is the goal, right? It's not a bad thing that you're seeing these shelter costs roll over here. And in my view, right, doesn't mean I'm right, but I think that is going to continue. I think that trend is going to continue. MBA Elias's homeowners insurance is catching up to mortgage rates. I mean, especially in states like California, Florida, and New York, depending on where you are in New York. I've been working some deals here, guiding clients, and some of the homeowners insurance rates, even in places like Red Hook, Brooklyn, South Shore, Nassau County, like Oceanside, Center Avenue, Long Beach. I mean, talk about crazy expensive. Yeah, I mean, you're totally right. I mean, who here is a homeowner and from 2022 to 2023 saw an increase in their homeowner's insurance? I actually saw a little bit of a decrease, but mine is ridiculously expensive as it is, right? It's over $4,000 a year, but I saw a teeny bit of a decrease there. Hey, Abdullah, what's up? Good to see you. The LT Prods is even if you own your home, property tax and maintenance are still the most. Yep, property taxes is another thing that's ridiculously expensive. Wow, Austin City Limits is mine increased by 18%. That's a lot. Storm Rider says, yeah, I saw my homeowner's insurance increase in Colorado. MBLI says, while BLS data shows a modest increase, real-world, real-time measures show the opposite, a decrease in the shelter component of CPI. Renee says, here in California, we are lucky if insurance doesn't drop us. Hey, I mean, Renee Thompson makes another good point. You're actually seeing some insurance agencies and insurance companies drop customers on coverage, particularly if you live in, the most desirable parts of California that are unfortunately susceptible to, wildfires and things like that. I believe in 2023, as we stand outside of St. Thomas Church, what you had is some insurance companies. I'm sorry?
I love St. Thomas Church.
Oh, nice.
Are you a huge fan as well?
Yeah, I like it. I think it's good.
Okay, I'm glad.
Awesome. Have a good night. Thank you. Cheers. Yeah, you know, you've actually seen some insurance companies come out and say, not only are we going to drop some policyholders, we're not going to write new policies in some states. I think State Farm is ceasing to drop or ceasing to write new policies in the state of Florida for homeowners and the state of California. So that is definitely an issue. Western Mass Davis is all insurance companies are exiting Florida. Most. Now we have like a government-backed insurance company called Citizens. Is anybody a homeowner in Florida? Chances are, if you are, like I am, your insurance company is Citizens, which is like a government-subsidized insurance company. So it's essentially a monopoly now. I don't know what the state of Florida is going to do about that, because if there's no competition, well, you know, what's going to happen to prices, right? They could set prices wherever they want. You know, we'll see. Yeah, but, you know, speaking of this whole dichotomy of, you know, shelter costs coming down, about 3 months ago, or I should say about 4 months ago, I wrote an article, and it was titled "In Order of Liquidity," right? So not to, you know, sound like a broken record, but we do have a lot of new people here. Generally speaking, right, if you've watched the news, you have all of these calls for, you know, the housing market is going to crash, you know, 90%. It's going to be the next 2008. And housing prices really haven't come down all that much. And it usually comes down very, very slowly, because it is a lagged effect. It's a lagging indicator. And that's because real estate, both commercial and residential, are very illiquid relative to equities. So when you have interest rates going up, equities or stocks reprice the fastest to accommodate for a higher interest rate environment, while real estate takes a little bit longer time to reprice. So if you want to read that article, if you scan the QR code on your screen and punch in your email, you can sign up for our free investing newsletter that we send out every other Thursday after the market closes. We sort of explain all these concepts in depth and cover the most breaking news in finance. Hey, Gadot, what's up? Robert Parker, good to see you. The LT Prod says, I am hearing car inventory is building up at dealers who refuse to discount after paying too much last year. Interesting. I haven't heard that. I don't really follow the car market too much. I do know that during the pandemic, the used car market went to Mars. I mean, some people were actually selling their vehicles for more than what they paid for them, but that's quickly subsided. And that was mainly, you know, due to the supply chain bottlenecks, that I don't think something like that will ever happen again, in my view. Because I believe everybody has learned their lesson to diversify supply chains away from China, right? The workshop of the world. And this is something we talked about too. That's why I think India, so I think the powerhouses in Asia moving forward into this next decade is going to be India, is going to be so the new powerhouses in Asia, I think, is going to be India, Japan, and Korea, because those are the three countries that are set to benefit the most from a movement away from manufacturing capacity in China to those countries. the St. Patrick's Cathedral to our left. Vinny's Jeep, Dodge, Ram, and Ford are going to have some real problems selling this year. Well, I was reading a report about Ford that apparently they lose about $30,000 every time they sell an EV. So the EV business is extraordinarily unprofitable for many of the auto OEMs, except Tesla. So I don't know how they're going to overcompensate that issue, right? I believe that's the number. You could double check that or fact check that, but I believe every time Ford sells an EV, they lose around 30,000 bucks. The LT Prod says CarMax has $3.6 billion in inventory, and Hertz is selling most Teslas due to lack of demand and high maintenance costs. I heard that today. Yeah, I heard that Hertz is going to be dumping their Teslas and using the proceeds to buy regular vehicles, right? Like internal combustion vehicles. It'll be interesting to see how that plays out. Mr. Davy says, yes, India has potential, but the president is a certified clown. Well, I don't know about that. I mean, if you look at the Indian equity market, right, the Nifty 50, I see up and to the right. That's what I see. I see up and to the right with very little volatility. And if you look at the Chinese equity indice, I see from the top left to the bottom right. I wrote an article about this on Thursday, last Thursday, and usually we can use equities, right, or stocks as leading economic indicators in and of themselves. So you have, I mean, and check out China. I mean, excuse me, check out Japan, right? Check out the Japanese equity indice that put in a top in 1989, right, going into 1990. The Japanese stock market has not hit a new all-time record high since 1989. And now we are only a couple hundred points off the all-time record high. And I think we're going to blow past that and go way higher. I think this is going to be a golden age for Japan. Look, that's my thesis. I'm bullish India, Japan, and Korea. So they're taking down the Saks Fifth Avenue light display here. But if you are all enjoying the live stream so far tonight, feel free to leave a like on the video and click the subscribe button if you're new. We do these live streams almost every day, starting at 8:30. Murray says the U.S. can't recover. Can't recover from what? Hey, Susanna Q4, good to see you. RB, what's up? Thanks for joining us. I think this is the last day that they are going to have the Christmas tree up at Rockefeller Center. Might as well check it out. Or maybe yesterday was the last day. We'll see. Hey Todd, what's up? Says your channel is helping my transition to New York City so much. Thank you, Todd. I appreciate it. And welcome to New York City, by the way. We're happy to have you here. It's a great city with great people, such as yourself. What's up, Joe? It is still up. Cool. It's kind of weird seeing it, right? This far away from Christmas. I mean, it looks beautiful. Wow. Okay, Bell says it's up until January 15th. That is such a cool shot of 30 Rockefeller Center. Look at that. So cool. And you can see the wind really picking up here again. Look at that. Now, just a quick reminder that next week we will be doing these live streams from Miami, Florida. Now, I don't know how many streams we're going to be able to get in because I was looking at the weather report and supposedly the weather is going to be really bad almost every single day. It's going to be almost like monsoon raining every day next week in Miami. Robert Parker says the United States can't recover from all the madness that is happening around the world in Ukraine, Israel, China, and perhaps North Korea. The U.S. can't recover from what? I don't understand. I guess I just don't understand the point. Recover in how? I mean, almost all three major equity indices are ripping, right? New all-time record highs for the market. Inflation is coming down. Yeah, I mean, if I was an investor looking globally, I would say US is probably the only game in town. Then I would say, you know, India, Japan, and Korea. That's where, I mean, if that's where I'd want my money. I mean, would you want to go and buy real estate in Russia or Russian equities? Troy Atmans is, yeah, the national debt. Yeah, the debt to GDP is egregious, but you know, here's the thing, and I used to be very, very extremely scared about that, but at the end of the day, it's like, yes, is it a bad situation, and at some point is it all going to come crashing down? But that the answer is yes, but that's going to happen in the debt market first. That's going to happen in the bond market. So you should be looking at the bond market for those clues. Because if there's ever a very big problem, you're going to see the debt market in the US sell off in a monumental magnitude, right? And that's going to cause yields to blow off and spike. So rates are going to go to the moon. They're going to go to Mars. And then you'll probably have a lot of cash funneling into commodities, gold, right? Bitcoin, things like that, oil. But right now, I mean, the bond market, yeah, it's had a little bit of a rally, but rates have really been on the decline. So there's not that much instability in the debt market. And I would say never underestimate how long the Federal Reserve can keep all these balls in the air, juggling all these balls, right? I think everybody agrees that the US spends like drunken sailors and that it is not sustainable and that we're kicking the can down the road and we're putting the younger generation in a massive mess. I think everybody agrees with that. Republican, Democrat, you know, whatever you are, independent, communist, hopefully not a communist. Anyway, I think we all agree with that, but nobody has a crystal ball to understand when that's all going to come down. So if you have been listening to all of the fear, all of like the fear mongering, right? Since the lows of 2008, I mean, since the lows of 2008 financial crisis, there's been people that have gone from, you know, thousandaire to millionaire to millionaire to multi-millionaire to multi-millionaire to billionaire to multi-billionaire, right? I mean, think about all the companies that have gone public since the 2008 financial crisis. And if you didn't follow the trend and pay attention to earnings, you would have been left out on all of that, right? So it's important to don't get so lost in the global macro, fear porn, as I call it, right? Because I think it can keep you out of a lot of big opportunity, right? We're in the situation we're in. Everybody's got to get up and go to work. The entrepreneurs are going to continue to get up out of bed in the morning. It doesn't matter if Congress spends another $2 trillion. There's going to be entrepreneurs waking up, starting new businesses, getting things done. They're going to need capital. They're going to raise money. Their companies are going to go public on the New York Stock Exchange. And there's going to be more Facebooks. There's going to be more Nvidias. There's going to be more Apples, that they're going to go from, $100 billion companies to opportunity to invest in them and get wealthy and rich ourselves. That's how the U.S. capital markets have worked for the last 100 years. Now, will that come to an end at some point? Maybe. I don't have a crystal ball. Is it likely that it will at some point? Probably. But, I think you got to be in the game and, invest your money on a timely basis. Because what if you're wrong and everything doesn't come crashing down? Well, then you're going to have nothing and you're going to miss out on the prosperity. But if you invest and you're diligent and you work and you grow a business, or you climb the corporate ladder of your company and everything falls apart, well, then everybody's all in the same bad situation. So it doesn't matter. So I don't know. That's kind of how I think about it. But we shouldn't be dismissive of those issues, because I agree. The national debt is quite embarrassing. Guys, look at that. Look at that. This is the Steinway Tower. This is the tallest and skinniest residential apartment building anywhere in the world. And it's right here in New York City. And this is Charles Schwab. This is my broker dealer. Hey, Josie, battery check. Let's see what we got. Wow, 50%? Guys, we're cruising. Hey, Rex A, good to see you. Thanks so much for joining us. Troy Atman says that's a good thought process. Townhouses, America equals the ATM for elites. That's a funny way to think about it. Carl Ross says Tom Ford has to get rid of all the unions, do the Tesla and contracts for each employees. Excuse me. Yeah, that's been another kind of clash, right? All right, let's head uptown because I don't want to go too far tonight because I got to be up early. I got a long day tomorrow. Hey, Luis Martinez is back. Says, hey Tom, a few banks announced earnings tomorrow morning. Do you think they will set the tone for the upcoming earnings season? I do, and that's going to be something that we are going to be writing about as well. When earnings season starts, right, it always starts with the major financial institutions. So the major investment banks, retail banking, credit card issuers and the like. And to your point, as you say, sets the tone for earnings season. You're correct, because we can use financial earnings and bank earnings as a proxy and a gauge for the health of the U.S. consumer. And we can do this in a multitude of ways. What I like to do specifically is pay attention to the following companies during earnings season as it relates to the financials. And we're gonna be breaking all of these down live on the stream, by the way. JP Morgan Chase, Bank of America, Capital One, Discover Financial Services, American Express, Goldman Sachs. Those are like the top ones to watch in my view, because they are the largest credit card issuers in the US. And we can garner a lot of data from that. One of the things I like to analyze is the delinquency rates. So the 30-day, 60-day, and 90-day past due for credit cards. You can get a lot of that data from Bank of America's earnings and the like, which we're gonna go through that. If you're subscribed to the newsletter, the Behind the Street newsletter, we do like archives of that. And delinquency rates are trending towards pre-pandemic levels, right? I would say the Q4 2019 levels. But we could also use that as a proxy for the business world, right? In terms of M&A activity, so merger and acquisition activity on Wall Street, and IPO activity. And this is something we talked about as well yesterday. There was a really good interview, right? A really, really good interview last week with Bloomberg. And Bloomberg invited the co-head of global investment banking on the show from Goldman Sachs. So Goldman Sachs' very own co-head of global investment banking. And according to him, right, and I think he knows what he's talking about, he is seeing the IPO markets start to open up again, and he is starting to see M&A activity open up again, like merger and acquisitions, right? So that is what I'm going to be paying attention to, and I am expecting that if you're an investment banker this year, my guess is that your bonus in 24 is going to be higher than last year's, because there's going to be more deal flow on Wall Street. That's sort of my thinking. Could be wrong, doesn't mean I'm right. Michael Joseph, good to see you, my friend. Says there's 1.2 trillion outstanding credit card debt. Gadat says loan consolidation credit cards, boom business. Scott says Jamie Dimon's still in the hard lending camp. Will be interesting to hear from him. Now, how many of you think that there's going to be some, wise guy analyst that's going to be asking Jamie Dimon what he thinks about Bitcoin on the earnings call now that the ETF got approved? I think there's at least going to be one. It'll be funny. I just ask respectfully, I'm not upset or anything. But no comments in the chat about underground tunnels, things like that. It attracts the wrong crowd to the stream, and it gets me in hot water, and people berate me with emails about it, saying, Tom, I saw, the comments about this and that. That's just not the topic I cover. So just respectfully, because it brings, like with the YouTube algorithm, it brings like troublemakers to the chat. And I just kind of want to walk around and relax and talk about the markets and not like the stuff. Just respectfully ask, that's it. Stephen Bates says, why you always talk about Bitcoin time? Why not talk about Ethereum more? Well, I'm a little bit concerned about a lot of the other altcoins, like the alternative, you could call them crypto coins. And I've sort of explained why. And it really has to do with regulatory clarity and regulatory certainty in the marketplace. Because Gary Gensler, who is the chairman of the Securities and Exchange Commission, the SEC, has already, and has done this for years, has already made a statement saying, look, Bitcoin is property, right? It is not a security. So that is regulatory clarity. However, the altcoins, like anything else not Bitcoin, like Ethereum, all the other ones, right? Down the line, they could potentially be classified as securities. And I'm not a lawyer, right? I'm not an expert in securities law, but my interpretation of securities law in the United States, if somebody came and asked me, okay, you're on a game show, Tom, make the decision. Do you think that these alternative coins should be classified as securities? I say yes. I say yes, because you have essentially founders of these software companies, right? That's really what all these alternative coins are. They're just software companies that have founders that distribute these tokens. But you can't just say, you know, I get a pass because I'm calling my security a crypto token, right? You know, if you have to be licensed and registered to solicit securities. So a lot of these founders, I'm not alleging anything, I'm just saying I'm not totally bought into it, and I don't want the problems, to potentially cover these altcoins and then have somebody else interpret that as I'm promoting this, and then that would then in turn classify it as, you know, soliciting unlicensed, unregistered securities. So until the SEC can really come out with clear parameters about it, I don't own any of this stuff, and very seldom do I talk about it. We just talk about the broader market, because the SEC is really clamping down on that. Like a lot of these crypto coin projects, especially during the pandemic, that have hired celebrities to promote these crypto tokens. But essentially they were promoting investments, and you have to be registered to do that. That's sort of my take on it. So and at the end of the day, it is the SEC's fault for this, because if you don't lay out clear parameters for regulation, you have way too much gray area. That's how investors get hurt. And then, just like the government always does, once everybody or the retail populace gets fleeced, right, so lose all their money, that's when the regulators step in, slap everybody on the wrist, maybe send like 8 to 10 people to jail to make an example out of them, and then provide the regulatory clarity. Why can't you just do the regulatory clarity before everybody loses their money? That's my question. So, I mean, think about how many cryptocurrency frauds there's been, like cryptocurrency style Ponzi schemes that have hired celebrities to promote to the public. And the celebrities, I don't think they had any malicious intent. I really don't think so. I think that they were just used, you know, not being mean, but just as a descriptive term, like a useful idiot, right? Like if I write a check for, you know, $3 million to, I don't know, XYZ celebrity to talk about this cryptocurrency, they think they're just doing a brand deal. But in reality, they're promoting an investment to their followers. And that's dangerous in my view. And a lot of them are getting sued for that. So, Greg says the regulators are in collusion. I don't know about that, maybe. I just think the government moves slow, like they always do, right? Last thing I'll say about it is, I think once we do have clear parameters, I think the cryptocurrency market is going to be like the second biggest asset class in the world, because some of these, you know, crypto coins are real, you know, have real utility in terms of like they're real software companies for things. It's just the way they go about raising money is through these ICOs, which stands for initial coin offerings, as opposed to tapping the public markets through an IPO. Troy Atman says, what is the building with the red columns? So those aren't red columns, it's scaffolding. We'll cross the street and I'll show you. But I'm actually really excited because apparently all of that scaffolding is going to come down this year. This is one of the most famous buildings anywhere in New York City. Anybody want to take a guess at what this building is? First person to guess, I don't know, you win. That's all you do. It's one of the most famous buildings in New York State, I should say. Hey, Joel PM says you're right about kicking the can. Seems the last resort is currency devaluation to feed that scarce debt. Yeah, that's true. At Carnegie Hall, you guys are right. Carnegie Hall. It's a bummer because the facade of Carnegie Hall is actually quite nice, but it's just covered amongst the scaffolding like everything is, right? So I got a funny story about this building, and then I think we'll call it a night. So there was a blackout, I think in 2016, 17? I don't know, I forget. So I was in my office on 6th Avenue, and I was just about to get in the elevator and then the lights went off. And I was like, whoa. So I walked down the stairs, and I go to the door guy, and he's like, yeah, I guess there was a power outage. Apparently, from 42nd Street all the way up to, I think, 72nd Street on the west side of Manhattan, there was a full blackout. Only on the west side. The east side had power. So I walk all the way up here, just because there was nothing better to do, and they evacuated Carnegie Hall while there was a concert still going on. And all of the musicians set up in the middle of the street here and continued the concert playing in the middle of the street. It was one of the coolest things I've ever experienced. I have the video. I'll have to dig it out on one of my old iPhones. But this is a new bodega that just opened. This place used to be abandoned for a long time. But if you guys are enjoying the live stream so far tonight, feel free to leave a like on the video and click the subscribe button if you're new. We do these streams every day starting at 8:30. Now this is 220 Central Park South. This is one of the most desirable buildings anywhere in the city. And that is Central Park Tower. Hey, Greg says, thanks. I like your streams. New York City is really beautiful, and I like your financial analysis. Good night. Thank you so much, Greg. I appreciate it. But everybody, I do have an early start tomorrow. It's going to be a very busy day. So I will see all of you tomorrow, probably starting at 8:30. So if you want to sign up for our free financial newsletter that we send out every other Thursday after the market closes, feel free to scan the QR code on the screen and punch in your email. Once you are a part of our Substack, if you download the Substack application, I just opened up a chat. So anybody who reads the newsletter is able to take part in that chat. I'm in and out of there pretty much all day, dropping interesting financial news. And in that chat also has the link to the free NYU Stern Business School corporate finance class by Professor DeModern. So if you want to take that class for free, it is in NYU Stern School of Business corporate finance class. Again, just scan the QR code on your screen, download the Substack app, sign up for our newsletter, and the link to the course is right there. So everybody, thanks so much. Appreciate it. And we will see you tomorrow. So Lisa Davis, I appreciate it. Gadot, Austin City Limits, Brody 23, Brad's Brain, appreciate you very much. Hawaii, Alex Y. There's always a bull market somewhere. You just need to know where to look. All right, happy early Friday to all. Take care.